Good morning, everyone. Welcome to the Grant Thornton's webinar on decoding personal income tax. Post the tax rate cut on corporate tax side, a lot of expectations are built up in this year's budget that we should see some changes in the personal income taxes. And rightly so, the finance minister did announce some good changes which should benefit a large number of employees or personal income taxpayers, mainly in the lower income groups. Before we start with the slides and the presentation, let me introduce our speakers on the panel today. I have with me Akhil Chandna from Grant Thornton, who focuses on global mobility services and employer and employee taxation. We also have with us two industry stalwarts and veterans in this field, Mr. Kamaraju Motiala from Nokia Communications, who is the head of EMEA Payroll Management Audits M&A. And second panel member from the industry is Mr. John Stephen Rao, or Steve, from Oyo Hotels and Home Private Limited, who is the AVP of Global Mobility Services over there. Both of them deal with thousands of employee and employee-related matters almost on a daily basis, and I think they will bring in a good industry perspective of the changes that have been brought in this year's budget. While there are many changes, I think what we will cover is a few of the significant ones, which include the new personal income tax regime, which is optional for individuals to continue with the old regime or new regime without the tax concessions. Residency rules, significant change has been brought in after many years, which will impact both inbound and outbound populations. Deferment of TDS on ESOP, a very welcome change. However, it is limited to very few startups which are covered within the definition of the income tax provisions. I think the demand from the industry is to enlarge the provisions and to roll it out for the entire industry at large. Significant change for high income earners on the ceiling being brought in for employers' contribution of 7.5 lakhs. We shall cover that in detail. Widening of the TCS provision and some other changes on dividend distribution. I think some significant changes have been brought in. Akhil, over to you to take us through some of the fine print in the new tax rates, especially the new optional regime which has come in for the individual taxpayers.
Thank you, Vikas. Good morning, everyone. Let's look at the first key change, that is introduction of an optional personal tax regime for individuals and HUFs. In a landmark move, a new and simplified optional tax regime has been proposed for individuals and HUF, which will be effective from financial year 2021. Any individual or HUF can opt for reduced rate of taxes subject to fulfilling specified conditions, which primarily includes foregoing certain exemptions and deductions, foregoing set-off of loss from house property against other heads of income, etc. In case of individuals with business income, the option, once exercised for a particular financial year, shall be valid for that year and all subsequent years. However, for other individuals who do not have income from business or profession, can exercise the option to avail lower tax rates on a year-to-year basis. As we can see, the slabs has been widened and 6 progressive tax rates has been introduced. The government has proposed that almost 70 exemptions / deductions are to be phased out under the new regime. These include many of the popular deductions mostly availed by salaried taxpayers, such as standard deduction, deduction for professional tax, exemption for house rent allowance, leave travel allowance, deduction of interest on housing loan for self-occupied property, and the various other deductions under Chapter 6A, etc. Interestingly, the new tax regime may be beneficial for expatriates working in India, as they generally do not avail deductions for HRA, LTA, or under Chapter 6A. This may also result in reduced tax costs for the business in case these assignees are tax equalized. There has been a lot of discussion and speculation on which tax regime should an individual opt for. Let's take up two simple illustrations and try to explain this question.
So Akhil, before we go to the illustrations, I think clearly it's a new mindset, new thought process which is coming into the personal income tax regime, just like on the lines of the corporate tax regime, where initially the government is giving an option to go for the earlier scheme with tax concessions or the new scheme without tax concession. 70 out of 100 tax concessions are being abolished or withdrawn, it clearly means that the government is aiming to simplify the overall tax structure, and I think that is the aim which we saw first in this year's budget, and maybe in years to come we may see all or most of the tax concessions going away over a period of time. Let's look at the illustration that we have now.
Yes, Vikas, I think you rightly summarized. It's about the mindset which government is bringing and asking people to look into the new way of filing the returns and complying with the provisions. So coming on the illustration, we're talking about the first illustration. In case of an individual with total salary income of 15 lakhs, the tax liability under the old regime will be 1,93,500, where only standard deduction of 50,000 and deductions under ATC and ATD are availed. However, the tax liability for the same income under the new optional regime without claiming any deductions would be 1,87,500. As we can see, in this case, the new regime is marginally beneficial for the taxpayer as it results in saving of 6,000 rupees. In the next example, an individual with the same salary of 15 lakhs also claims certain other deductions such as HRA and deduction for interest on housing loan of 2 lakh rupees. Altogether, deductions result in reducing the taxable income, and accordingly the tax liability is reduced to 78,500. However, if this individual were to opt for the new regime, the tax liability would remain the same as discussed in earlier example, that is 1,87,500. The tax outflow under new regime is in fact higher by 1,09,000. As we can see, where the number of deductions foregone is high, it may be beneficial to stay with the old regime. It may be reasonable to conclude that there cannot be one final view as to whether the old regime or the new regime is beneficial for an individual taxpayer. One would have to analyze the tax liability under both the regimes before making a final decision.
So what we are saying, there is no sure-shot answer today in terms of whether an employee should continue under the old regime with tax benefits or give away the tax benefit, but likely that every individual is going to gain, especially in the lower income brackets. I think a very welcome move by the government. Before we move ahead, I would like to ask Kamraj in terms of his perspective, because obviously you have systems and processes in place and there will be a lot of changes which will be brought in. How do you see? Of course, individual employers will love this change because it saves them some taxes, whether it is 5,000 rupees or 1 lakh rupees on an overall basis. But how do you as an employer running payroll and global mobility services for thousands of employees moving in and out of India? So Kamraj, how do you see this change in terms of practical challenges?
Hi Vikas, very good question, but I think this is the first budget I can see in my life with two options running in the financial year. I never see, I don't know, before my
Very interesting. First change with two regimes.
Yeah, two regimes. This is a new experience. But of course, what you mentioned, the people under lower income, they without any exemption, they may get the good benefit. But as an employer point of view, when you're doing the education, beginning of the financial year, when you're asking the employee options, again we need to ask the options 1, option 2, which options for the employees. That is one challenge because it creates a lot of time for the employer point of view because there are a lot of queries and a lot of awareness and education is required to employ which option is better for which scenario. That proper because any organization, most of the people are technical and business related, not finance related and tax related. So obviously it is additional load for the payroll team. And also there are a lot of clarifications required because I can see that some challenges like when you're filing the quarterly income tax return. So are we supposed to file the quarterly income tax return for the different options, or we can combine one quarterly income tax return? Because the present quarterly income tax return form 27A, the format is particular format. So we cannot mix both options. So we need clarity. And also when you are looking the retirement options, I don't know, new scheme without any concession, any deductions, any rebates. That means are we not encouraging any retirement plans? Because in India there is no social security protection security cover. That means who will take care of our employees' retirement? Neither government nor our savings. So that means a big question for everyone. So that is my personal feeling as of now.
Fine. So it means a global company with system and process in place will have to realign or rejig the internal systems. That is one. Second, how do we file the quarterly tax returns? There needs to be some clarity. And third, a sore point which majority of the individuals have in terms of benefits, especially Section 80C and other retirement benefits going away. I think there was a nudge factor earlier available to save or compulsorily save by way of tax saving, that is going away. I think the government's mindset is with the younger generation coming in, let them decide. But again, industry thinks that there is some concession which should have been there for the retirement plans. Steve, you represent a growing, very fast growing Indian global company which is expanding its footprint very widely across the globe. How do you see this change vis-a-vis your employees who are moving in and out and you are expanding your footprint?
So, a couple of things that have not yet been addressed, and this is something which will, I'm sure that will be addressed in the days to come, is how does it change the rules? So, while the budget looks at the act, it does not necessarily change the rules. And some of the deductions which are available are there in the rules. And so we'd have to look at how the per diems is going to be taxable. We're going to look at how the travel policies are going to be amended based on that. But that's on the tax part. But if you look at the overall structure, the way I see it is the government is slowly moving away from a saving perspective.
Right.
And it's simplifying its processes, if you will. If you look at the processes for foreign countries, you would look at the US tax returns or the UK tax return, you do not have too many exemptions. And I think we are inching towards that, wherein a standard deduction would be given or a standard exemption would be given based on the family size or based on your living conditions. But eventually, I think this is going to phase out. It's going to have teething issues in the current year or maybe in the next couple of years, but I think that's what I predict. One more thing that I see is while the assessments also should reduce because the tax returns are going to be simpler. If a person opts for NSS, opts to file a tax return without claiming on the exemptions. So we'll have to just wait and see.
Very interesting points you raised, Steve, that in terms of tax concessions, it will simplify. There will be less litigation and disputes, and probably we are moving towards more mature tax jurisdictions like the US or UK or the other, where there are very limited number of tax concessions being given, and it's easier for the individuals also to comply with the law of the land. In terms of another significant change, I think the residency rules have undergone a big change this time, which will impact people moving in and out of India. I think, Akhil, let's go through some of the fine prints in terms of what are the significant changes in terms of residency rules, because that impact individuals, employees who are moving in and out of India, that impacts the promoters as well as high net worth individuals who have some family members staying outside India, and they also keep on having different residences during different periods of time. So let's go through some of the fine prints over there.
Yes, Vikas, this is again one of the most significant change, and where we've not seen government touching residency conditions, for number of years. So the government has now proposed some changes in these provisions which are likely to impact, as you rightly said, Indian citizens, person of Indian origin, and other globally mobile employees in determining their residential status and resulting taxability in India. The first key change in residency provisions applies to Indian citizens and person of Indian origin who, being outside India, visit India for various personal or other reasons. Under the existing conditions, such a person will qualify as a resident in India if he meets the cumulative conditions of being present in India for 182 days or more during the financial year and for 365 days or more during the preceding 4 financial years. The threshold for number of days presence in India for such individuals has been proposed to be reduced to 120 days. Effectively, this means that an Indian citizen or a person of Indian origin can plan the visits to India for about 4 months now as against 6 months earlier. We have received questions on whether overseas citizens of India are covered under this change. Yes, as OCI card has now been merged with PIO card, and therefore the change would apply to OCI card holders as well. Also, this change does not impact foreign citizens visiting India, and they will continue to qualify as resident in India in case their stay is 60 days or more during the financial year and 365 days or more during the preceding 4 financial years. Let's understand the impact of this change through an illustration. Mr. A, an Indian citizen, has stayed in India for 170 days during financial year 2021 and 400 days in the preceding 4 financial years. Under the existing rules, he would have qualified as non-resident since his presence in India during the financial year 2021 is not more than 182 days. However, under the proposed conditions, Mr. A would qualify as tax resident of India for financial year 2021. So this is again a big shift which would impact a lot of people.
So again, what in your view could be the possible reason for reducing this to 120 days now?
Because we have seen the trend that people manage their stay in multiple jurisdictions by keeping their stay in India for less than 182 days and considered as a non-resident.
Okay.
You know,
so probably for people who have been able to stay in different parts of the world,
yeah.
but were not paying taxes in India, probably the government is trying to widen the tax net if they have business interest or other interest in India and closer ties with India to bring them in the tax net. So I think this is again a move toward widening the tax base.
Yes. So this change indicates the government intention to plug the issues in case of individuals who are actually carrying out substantial economic activities from India.
Interesting.
Manage their stay in such a way to remain a non-resident in perpetuity and not be required to offer global income taxable in India. So to plug this issue, government has bring this change. Now let's move to another slide, which is again I think a major shift because the government has tightened the residency rules for Indian citizens and PIO visiting India. A relaxation has been provided in the criteria for qualifying as a not ordinary resident. Under the existing conditions, an Indian qualified as a not ordinary resident, if he met any of the additional conditions, that is, either qualified as a non-resident in 9 out of 10 preceding tax years or stayed in India for 729 days or less during preceding 7 tax years. However, these conditions have been relaxed. Under the proposed conditions, an individual would qualify as not ordinary resident if he qualified as a non-resident in any 7 out of the preceding 10 tax years. To understand the impact of this change, let's continue with our earlier example, wherein Mr. A, an Indian citizen qualified as resident of India, being present in India for 170 days during the preceding financial year 2020-21. Let's assume he had qualified as a non-resident for 7 years from financial year starting from 1340 to 1920. Now we need to determine whether he qualifies as a not ordinary resident in financial year 2021. Under the earlier rules, Mr. A would have qualified as ordinary resident and accordingly would have been liable to pay tax on global income. However, under the new rules, Mr. A will qualify as not ordinary resident as he was a non-resident in 7 preceding tax years.
So I think, Akhil, this is a very interesting change brought in terms of 9 out of 10 versus 7 out of 10 years, which provides a big relief and relaxation to the people who fall under this category. And to put things in perspective, effectively it means that for the inbound assignees, people moving into India, this is a very positive development, and now they can qualify as ordinary resident, which means getting directly taxed on the global income with increased number of years compared to the past in terms of the assignment. Steve, do you think it will be beneficial for the employees also in your case or in general to the people moving into India?
Yes, so for people moving into India, they would not be liable to tax, like you mentioned, on the global income for at least 5 first 4 years, and then it applies to them. And for people who are going out of India, again, if a person is spending 4 months in a year in India when he is supposed to be traveling on site for a job, then there is a question on legitimacy of whether he is actually working there or not.
Interesting.
So I think it would put all those questions to rest.
Kamran, your perspective on this?
Yeah, basically when you are talking about the changing the status from NR to WAR, because basically when you are reducing the 182 days to 120, the major challenge we need to calculate the GSY, gross statement of the earnings. Whatever the earnings you earn outside India, we need to calculate. In case of non-resident, definitely we can skip this activity and whatever the taxes he paid in the host country, that will be there. But whereas once he become a resident due to less than 120 days, the condition parameters, then definitely the entire whole exercise, we need to calculate the travel expenditure, business travel, maybe accommodation, hotel, taxi, etc. So we need to compute all the GSOE and if required, we may apply the FTC, foreign tax credit, then lot of structure is required.
Yeah.
That means it is indirectly we are paying more taxes as well as we are doing lot of work. That means very well time and money both we are spending here. So that is one challenge I can see here.
Interesting. So, in general, what we hear the industry perspective is that this is a positive move, will help incentivize movement of global talent in and out of India, especially with this change into India, whether it is for expatriates or for Indians who can now look for a longer stay in India in comparison to the past. And second, as Kamraju mentioned, that if a person is non-resident, there is lesser compliance vis-a-vis overseas income. And I think this change is a very positive move, Akhil. Now let's look at another big change which has come in terms of deemed residency. There are few countries in the world which tax their individuals based on their not only residency but on their citizenship as well. For example, US is one particular example where a US citizen is required to file his or her tax returns and probably get taxed on the global income subject to certain foreign tax concession, etc. I think this is the first time we are seeing a big change under the Indian tax statute where we are moving towards our taxability linked to the citizenship. That is one. Second, initially on the day of the budget, which was 1st Feb, an impression was created in terms of the interpretation that if there is an Indian citizen working overseas, especially in the Middle East, and he is not getting taxed over there, probably he will have to pay tax on the entire income over here. I think the government and the Ministry of Finance moved very fast, issued a clarification the very next day. I think we soothed some of the nerves in terms of the taxability. So what's our take in terms of deemed residency, Akhil, on this?
Because as you rightly said, this is one of the most talked about change proposed in this budget. Introduction of a new concept of deemed residency, which is actually a citizen-based, regime. So, but it is important to note that a deemed residency will not lead to a taxability. We need to further analyze whether a person becoming an ordinary resident or not ordinary resident. To take an example, as we mentioned in our slide, Mr. A, an Indian citizen, has his base in India and splits his time between various countries during a financial year and thereby qualifies as a non-resident in India as well as other countries. As the proposed conditions, Mr. A would qualify as deemed tax resident of India in all these years. Further, as mentioned in our registration, based upon his stay in India, he would qualify as not ordinary resident for the first 4 years and then as an ordinary resident in the 5th year. This amendment is likely to impact high net worth individuals who are liable to avoid paying taxes in any jurisdiction by managing this stay. This amendment has been proposed to plug the issues around double non-taxation.
So the key issue is avoidance of double non-taxation is being addressed in a phased manner. And I think this is first step. We may see some changes again being brought in over years in terms of the deemed residency linked to the citizenship and closer ties with India. Very interesting changes. Few years back, the government introduced the concept of significant economic presence. Then we introduced digital taxation, and I think now this is a new concept which is being brought in mainly to ensure that there is no double non-taxation happening in case of either the corporates or the individuals, which is the topic of the day. Steve, do you think this amendment will inadvertently impact the global employees in terms of especially who are in the high net worth tax brackets?
Yeah, so in terms of when we look at global mobility, we have to look at people who are traveling from one place to another. So business travelers would continue to be taxed as residents in India. But if we're talking about an assignment, it is generally deemed to be a short-term assignment or long-term assignment. So here, I do not think the deemed residency would play in.
Okay.
Unless some, I don't think it has a significant impact on global mobility perspective.
Mm-hmm. So it will not have a very significant impact vis-a-vis the population that you deal with.
That I deal with.
Right, Steve. Kamraju, do you think it will have an impact vis-a-vis the employees that you have?
I agree with Steve. Basically, when you are talking about top leadership, there is not much significance in this team relationship part because already we are backing with all the long-term SNEs or short-term SNEs with the quality of living allowance or cost of living allowance or all the premier cost we are already taking there. So that's why I think nowadays most of the companies they take care of all the taxation and everything. So hence I don't think whether it's deemed or not deemed, but companies are already having this role. So that's why I don't think there is much significant change required in companies' point of view.
Thanks, Stephen Kamaraju. So what we are hearing is the larger companies which have systems, processes, and well-defined global mobility policies, this may not have a major impact because everything gets tracked in terms of the number of days of stay in India, overseas. Taxability is very well defined in terms of what gets taxed in India, what gets taxed outside India. Similarly, perquisites are very well defined and fall within the tax level. I think the two areas where it could have impact is one, self-employed individuals who are moving from India to outside India and doing various assignments over there. Second category which could see impact would be the promoters and high net worth individuals who have a base in India, businesses in India, as well as base and family members and businesses outside India. Over there, I think this point assumes a lot of significance and that needs to be examined vis-a-vis the other changes also which have been brought in the tax net in the last few years. Let's change tracks now, and one of the key demands both from the industry as well as the individuals has been vis-a-vis the taxability of ESOPs. Currently, the ESOPs get taxed at two stages. First, at the time of exercise, when an employee exercises and intimates his intent to the employer, the benefit is taxed as perquisite, and second leg is the taxability at the time of sale. There has been a demand, especially from the MSMEs as well as startups, to shift the taxability to sale of shares, because many a times the valuation of the companies and the startups go up and down without any reason vis-a-vis the employees of the stock option plan. And in case the employee has exercised the option at a very high valuation, then he or she ends up paying a lot of taxes vis-a-vis the point in time when the shares are actually sold. The valuation at that stage could be very different, it could be even lower. It is not that the valuation will continue to go up. We have seen in many cases the valuations going up and down, and that's the very nature of the startup business. So this demand has been partially met, number one. Number two, it has been met only for very specific startups. So I think, okay, let's look at what the change has been brought in, and the demand and the request from the industry to the government has been to widen it to provide this beneficial provision to everybody. Why restrict it to few specified startups? So what's the changes that have been brought in which are a relief for the employees of the startups?
Yes, because so currently, if you see, there's a concept of 2 point of taxation for ESOPs. That is, firstly, as a perquisite in the year of exercise of options, and second, as capital gain in the year of sale of shares. The tax on perquisite leads to have cash flow problems for employees as this benefit is in kind. So in order to ease this burden and to remove difficulty in payment of taxes by the employees of eligible startups, it is proposed to defer deduction of TDS by an employer on such ESOP perquisites by 5 years. Now the TDS has to be deducted and deposited within 14 days from first expiry of 5 years from the end of the financial year in which ESOPs has been exercised by the employee, or date of sale of shares by the employee, or date on which an individual ceases to be an employee, whichever occurs earlier. The TDS rate would be at the rates enforced in the financial year in which the ESOP was exercised. So though they come out with reducing the burden to the employees, however, there are lot many clarifications or corresponding amendments which are required, and we have to see how the government will come out with those in the coming days.
So 5 years from the end of financial year in which the options have been exercised, or date of sale of shares by the employee, or cessation of employment. Steve, I think many Indian companies which are having global footprint and which are attracting talent like yours are offering ESOPs very generously to the employees as an effective tool of attracting and retaining talent. I know you may not get qualified within the narrow definition of startup which are getting covered over here. What's your perspective on this provision? I'm sure we were discussing this should be widened, but what's your perspective on this?
Yeah, so couple of points. One is this is a very welcome change that the government has brought about, and it's very supportive of the startups. And but the point is, it's very narrow. So, for example, if you take our company, it is we may not be qualifying this. We will not be deemed as a qualified startup. But this is something that we need to widen because, as you rightly mentioned, the valuation of the stock may go up and down. And then, when is it that we would want to give ESOPs to the employees? When is it that they're going to exercise? And so those are the things that we would have to continue to look at. But effectively, there are a lot of other startups which have been there for quite some time. And if they do not cross that, if they cross the 10-year threshold, and they might have started looking at a prospective gain now, that is when the ESOPs would actually have some valuation.
Very, very good.
So, do they get kicked out of that regime or not? That's something that we need to, I think, address in the platform.
Okay, let's go through the illustration to better understand this issue at hand.
Yeah, so we've covered all the situation. We've taken Mr. A exercise 100 stock options with a purchase value of INR 1 lakh rupees. Date of exercise of option, the date is 1st April 2020, and the tax rate of financial 2020-21 would be applicable. So let's assume three different situations. Situation 1, Mr. A does not leave the company nor sell the shares. So what will be the date on which employer needs to meet the TDS compliances? In situation 1, the date, as we said, will be applicable of 2021, but the date to deposit and deduct taxes would be 14th April 2026. So there is a deferment, clearly a deferment of 5 years for employer to discharge withholding tax liability on the ESOP perquisites. In situation 2, let's assume that Mr. A sells the shares in 2022 and 23 on 1st May 2022. There, the date on which the liability triggers for employer to do the withholding is 15th May 2022, which is 14 days from the date the shares are sold by the employee. Similarly, in situation 3, let's assume Mr. A leaves the company in 23-24 on 1st September 23. In that situation, the liability comes on 15th September 2023. So we've covered all the three situations and give these dates which are proposed in the budget.
I think besides the demand from the industry and employees in general to extend it to industry at large and not restrict this benefit to startup, some of the practical issues that need to be addressed include, while a provision has been introduced in terms of deferment of the tax withholding from the employer's perspective, the chargeability vis-a-vis employee remains intact. I think there is some dichotomy over there. We are quite hopeful that once the government comes out with clarification in terms of the TDS and other provisions, this dichotomy should be resolved. That is one. Another interesting issue which is coming up from the startup world itself is that if at the time of grant of options the employee is eligible because the startup definition is satisfied, if at the time of exercise the startup definition is met, what about if at the time of later on post exercise the startup definition is not met by the employer? Will the benefit continue? Looks likely. Let's look at another example. At the time of grant, the startup definition is met, the startup criterion is met, whereas at the time of exercise, for no fault of employee, the eligibility criterion for a startup, which is defined under the statute, is not met. Will the deferment of tax provisions, which are beneficial provisions, will get triggered, or will the employee have to pay taxes then and there as per case? I think there are combination of issues which arise even vis-a-vis the startup. But having said that, I'm sure the government will come out with clarifications as we go along. A very positive change. I think industry's demand is to extend it to all the companies. Kamraju, yours being a global company, I think two issues arise over there, especially in terms of stock options which are granted by global companies to the Indian employees. There is always a challenge over there. I think some clarity is required over there as well in terms of trigger of taxability, etc. And second is in context of the accounting rules. Also, there have been challenges as to when to account for it and whether you can claim tax reduction for the same or not. Any practical issue that you have heard from the industry at large, whether it's global companies giving options to the Indian employees?
Yes, because there are a couple of challenges when these stocks allotting to the Indian employees for the global company.
Right.
Basically, the market here in Indian stocks there is one parameter, one criteria, that is only Indian rate. But whereas when you're talking about the international stocks, there are two parameters we need to consider. Factor one is FX rate, foreign exchange rate, and second is the market fluctuation under FMV, fair value method. So employees will get the lot of challenges. One is during the allotment that either generally all these shares in everything retention basis, maybe 5 years or 3 years retention. So during the retention, the employees will caught all the challenges. So one is the FME calculation at the time of taxability. Sometimes due to these issues, high fluctuation in the market for FX rate, the people need to pay more taxes. And same time, when you getting the tax capital gain, that will not consider as a capital because any sale of these stocks and the internal that considered as other income. So we cannot get the capital loss or capital gain benefit in the ITR. That is one challenge I can see.
Very interesting. Besides the tax and accounting, what Kamaraju mentioned was that global companies giving options or such benefits to the employees also have to tackle with foreign exchange and market valuation issues. Thanks for the industry perspective on this. Akhil, another significant change which has been brought in the budget is vis-a-vis the employer's contribution towards Provident Fund, NPS and superannuation schemes. I think that will impact a large number of employees in the higher tax brackets. Let's first go through the changes which have been brought in and then we can debate about how and where it will pinch the most.
Yes, because I think this is a big change. So as per the existing provisions, employees' contribution to recognized provident fund, superannuation fund and national pension scheme is exempt from tax up to a certain prescribed limit. That is, in case of recognized provident fund, up to 12% of salary without any monetary limit. In case of approved superannuation fund, it's 1.5 lakhs. In case of national pension scheme, up to 10% of salary for non-government employees without any monetary limit. Further, it is pertinent to note that there is no combined limit for the purpose of claiming deduction, benefit or contribution made by the employer. Now, the change which has been proposed in this budget is, to introduce a combined upper limit of 7.5 lakhs in respect of employer's contribution and also tax any excess contribution as perquisites. So this, also any annual accretion paid by way of interest, stroke dividend on such excess contribution to be taxed as perquisite in the hands of employees. So this will impact, the people who are in high salary income prone. And we have to see how the industry will get ready for this because I believe each and every company will get impacted on this.
So currently there is no overall ceiling, Akhil, and the government has introduced 7,50,000 of the overall ceiling. So I think two comments on that, and the panel discussed earlier that probably some of the earlier concessions which are available for retirement planning and saving, they are also getting hit because of this. Second, definitely it impacts the employees in the higher income bracket, where a lot of salary structuring was done in terms of the employer's contribution going into these schemes. I think the other side, with the government's perspective or the revenue authority's perspective, is that it also offered a big concession for the high income earners to structure their compensation vis-a-vis these components, wherein roughly 20% plus of the overall compensation could be structured and invested in these kind of things. Steve and Kamaraju, this is like two sides of the same coin. Helps in your retirement planning, saving funds in a very legitimate manner, whereas government was losing revenue on the savings which are through the compensation structuring, whereas the intent of the government has been to give benefits to the larger population, the lower income brackets. Like in the current year, below 15 lakhs, a lot of concessions have been given this year in terms of the alternate regime. So, Kamraju, how do you see this change being brought in?
Okay, because basically, you're saying well correct. When you're talking about this capping into earlier there no cap, water unlimited. But now, after achieving the capping of the 7.5 lakhs, number one, government to define the mechanism, because now the 7.5 lakhs is a capping of the all type of the investment like NPS, superannuation, PEF, etc. So I don't think is there any sync system between the all the three mechanisms. So first we need to identify the mechanism between the all the investments. Until unless if there is no mechanism, then it is difficult to calculate 7.5. That is one way I can see the loophole. And second point, definitely since the group of the high people very low group, but there are a lot of money we have. So why government is not properly utilizing the contribution revenue from this one? Why is they stopping revenue? And also coming to this point, the capping of the 7.5 lakh. Now, as I mentioned earlier, the retirement plans and everything, savings and everything. So if you stop this revenue, then how it will go to the generation of the revenue and cash. So these are the problems we expect from the new generations.
Interesting. Steve, what's your perspective on the cap of 7.5 lakhs? Why not make it 10 lakhs or why was it not 5 lakhs?
Yeah, so I have a mixed view on that. So if you do a rough math for 7.5 lakhs and employer portion of 12%, so the total salary should be around 60 lakhs.
Interesting.
And for a person who's drawing 60 lakh, does he really need so many incentives? Is what the government is looking at.
I think you're talking more from the government side today.
No, I'm not. So I'm just trying to think through the way the government is thinking through. So for a person who's drawing 60 lakhs, do you really want to give so many incentives? The whole budget was about incentivizing the poor people. So that is one part. Another, but where it really hurts us is that if you look at the retirement scheme across the world, either it's contribution based or it's benefit based. And Indian retirement scheme is contribution based. So here the government does not take care of you when you're old and you die.
No social security system.
No, there is none. So if the government is willing to step in and say that this is what we would like to do, give better hospitals and better social security system to our old age employees, this provision looks good. But otherwise, I would say that they should incentivize savings so that employees can take care, or most of the people can take care of themselves when they're older.
I think while it impacts the income earners in the higher income brackets, in general, the thought process is positive that yes, government should provide the benefits where it is required, which is a low income earner. But at the same time, a small grievances, there should be mechanism to save for post-retirement, because unlike the developed world where similar incentives are not there, but we also do not have a comprehensive social security to take care of you for the medical, retirement, and even in case of job losses,
Yes.
there is no unemployment insurance or benefit which are available through the government mechanism. So overall, a mixed response on that. Let's look at a new regime being brought in, which I would call a new regime on taxation of the remittances, which we have seen for the first time, Akhil. I think let's go to the fine print what has been brought in over there and see how things will work in future over there.
Yes, Vikas. So I think with an objective to create a tax scale of foreign remittance, it is proposed to collect tax at the rate of 5% on all foreign remittance of 7 lakh or more done in a financial year under the LRS scheme through an authorized dealer. This amendment will have a huge impact on the individuals who come to India or go outside India for any purpose, being it business or employment, as they may face additional tax burden while remitting any sum outside India under the LRS scheme. The common remittance covers remittance for studies, medical treatment, maintenance of family, holidays or investments abroad. The proposed amendment has covered all such remittance for the purpose of levying TCS at 5%. The authorized bank will be responsible to collect taxes from remitter and deposit the same with the government. Although the credit for such taxes may be claimed by the remitter while filing tax returns in India, however, the problem arises when the remitter is non-resident and is not liable to file tax return in India. In such cases, is the government trying to widen the tax return filing base, as individual remitter would now be required to file tax returns in India to claim TCS refund even when not otherwise obliged to file tax return. Apart from the above, there is another change, Vikas, which talks about TCS at the rate 5% will also be attracted on purchase of overseas tour packages. I think the above leads to a lot of open-ended questions which needs clarity, and I'll hand over to you to discuss with the panel.
So, under the liberalized remittance scheme, an individual can remit up to $250,000 on a yearly basis. I think what the government witnessed was there was a lot of remittances being planned for various purposes. Probably there were certain instances where they felt that probably the remittances lacked the genuineness for the purpose for which the remittances were going. So I think this is a mechanism, A, to get an audit and tax trade, and B, in order to get some revenue, which is through the TCS mechanism. I think that TCS rate is 10% if the person is not able to furnish a valid PAN or Aadhaar card. That's also important. Now, having introduced this on payments above 7 lakhs is understandable. Having introduced on tour program packages will again lead to issues where it is applicable to a tour program package or airlines as well, or the hotel stay. What about if somebody goes and buys say a Disney ticket online, whether it will be applicable over there or not? And I think enforceability will also be a challenge vis-a-vis Indian businesses. You can enforce it. Whereas if somebody goes and makes a booking on online portal which is run from overseas, how will you enforce it? Steve, your take on that?
So those were exactly my thoughts. How would you enforce that?
Absolutely.
Because when it is with the company, it's easy to track, and there are audit mechanisms which are already available to make sure that the remittances are adequately all the remittances are audited. But in terms of individuals, we are looking at $10,000 worth of money that is exempt, and anything over and above that becomes taxable. So I think it is burdensome for people who would be remitting the amount back into India.
Interesting. Kamraju, what's your take? Because you have globally mobile population, few thousands of people moving any given point in time on an yearly basis. Does that impact you?
Yes, because we need a use, and in addition to this one, if you take an example, short-term SMS, there is a lot of huge cost. Company are supposed to pay a lot of cost, like air tickets, hostel, accommodation, etc. So it will be a huge spend and a lot of exercise for the refunds and everything. And also there is a lot of clarity is required. Now the clarity is defined only a couple of categories like all these. But other than this one, there are a lot of miscellaneous expenses. So how we take care of the clarity, that is also important for us. But huge cost.
I think what we are hearing is that the intent probably was to track the remittances going overseas through TCS mechanism. Now I think some clarity or some leeway will be required in terms of the tour program being booked by individuals vis-a-vis the corporates, which are genuine business travels happening. And many companies just give a travel card or a credit card to the employees to make those bookings. Whether it applies on those as well, looks like. I think some clarity will be required to give some concession or leeway for the genuine corporate travels vis-a-vis the remittances being booked by individuals and families for the tour program. I think this issue will involve and probably may result into some disputes and litigation as we go along.
And because one more point here, what you mentioned, in case there is no Aadhaar and PAN, so obviously it will be given 10%. And also there is one more. There are in corporate. Generally, I think I can say around 20 to 25% trips are always rescheduled or cancelled.
Right.
So those costs, how will you take care of this? Because in the budget, I didn't see the cancellation or rescheduled cases. What is the implications of the TCS? So that we need to get a clarity. Confirm the trips, I'm okay. But unconfirmed, cancelled, rescheduled, what is the cost?
Very interesting industry perspective coming in that if a trip gets cancelled, whether the TCS amount gets refunded then and there, or you have to still file a tax return. I think this will require some clarity. And as you rightly mentioned, about 20-25%, the rough figure that you shared with us, is the amount of either cancellation or rescheduling. And these are business realities. It's not a theoretical thing that we are asking for. Some clarity required on that. Let's move further. Akhil, dividend distribution tax regime has moved back to the classical system of taxation, a long pending demand of industry, helps the foreign companies which have made investments into India. It does impact individuals as well, and especially for high net worth individuals, it impacts adversely because earlier the tax rate was lower, roughly about 15% plus surcharge cesses amounting to roughly about 21%, whereas in the higher income bracket it can go up to 37 or 43%. Let's go to the provisions that you this.
Yeah, so because the scheme for payment of dividend distribution tax by companies was introduced by the Finance Act 2003, post which domestic companies were required to pay tax on dividends, and dividend itself was exempt in the hands of the recipient taxpayer. Subsequently, Finance Act 2018 has reintroduced taxation in the hands of recipient, though with taxability triggering on dividends above 10 lakhs and at the rate of 10%. Now the government has proposed to remove the DDT framework and restore the classic system of taxing dividend in the hands of taxpayers. Hence, with effect from financial year 2021, any amount received as dividend would be taxable as per the slab rate applicable to the taxpayer. Also, the company would require to deduct tax at source at the rate of 10% where dividend exceeds 5,000 rupees. This amendment would benefit foreign shareholders as they now be entitled to claim foreign tax credit for tax withheld on dividend in India. Under earlier regime, the DDT was not eligible for foreign tax credit in their home countries. Also, foreign shareholders may claim lower withholding tax rates, if any, as per the respective tax treaties with India. So that's the overall change, which looks beneficial for non-residents. However, as you rightly said, the people now, earlier they were not impacted by dividend that much in terms of taxability, but now it's taxable as
well. So right, beneficial for individuals in the lower income brackets,
yeah,
because now that gets added in their income. So if you are below 20% tax threshold, you will be better off. Whereas if you fall in the high income brackets, your tax liability on dividends will go up.
Yeah.
It was a long pending demand, the government has met it, but again, two sides of the same coin, it will have positives as well as not so positives for the individual. Another interesting development in the budget is the direct tax amnesty scheme in terms of resolving the disputes of the past years where their issues have been pending before different forums, whether it is the tribunals, high courts or supreme courts. I can briefly touch some of the salient features of the scheme now.
Yeah, so this scheme is applicable both individuals and corporate taxpayers, and it's applicable to matters pending before appellate authorities, be it ITAT, High Court, Supreme Court or CID appeal as on 31st January 2020. Now, how it works, if the dispute pertains to tax liability and you want to settle before 31st of March 2020, then 100% of disputed tax amount is required to be paid without any interest and penalty on that. However, if the dispute pertains to interest, penalty or fees, 25% of disputed interest, penalty or fees needs to be paid along with the tax liability.
So I think this is a big change vis-a-vis the amnesty scheme which was brought in for the indirect taxes, primarily services tax and excise duty, where there was a huge concession being given on the disputed tax amount as well. Whereas under a direct tax amnesty scheme, there is no concession on the disputed tax amount, and individual will have to pay 100% of the disputed amount. The relief is primarily on the interest and penalties paid before 31st March 2020, and some extension if it is paid later on up to the end of the scheme, then the amount goes up, which is 10% of disputed tax amount, and by another 5%, which is 30% of the disputed interest and penalty. I think there are certain other proposals also in the budget in terms of e-appeals and e-penalty scheme. I think we are moving completely towards faceless assessments. What's your take on that?
You rightly said, I think in the last budget, the government has already announced a lot of schemes around that, and we have seen the implementation at the ground level. And these e-appeals, e-penalty schemes will create a confidence amongst the taxpayers on the transparency and things going in the right manner. Similarly, one of the major update done on reporting requirement by donor organizations. So earlier, whatever donations we need to make, it's an individual who used to claim in the tax return file, and there was no information submitted by the donor. Now, one-to-one matching of donation received and deduction claimed by the donor assessee. The reporting has to be done by the people receiving the donation, so that there's no mismatch and the claim is genuine. So these are the two big proposals, I think, which have been announced, proposed in this budget.
So Steve, while this does not come directly under your purview in terms of the appeal and assessment, but you feel that we are moving in the right direction as a country in terms of getting into more tax transparency. I think one of the key concerns of the taxpayers, especially individual taxpayers, has always been that probably the little harsh treatment that they get sometimes with this tax assessment, including the complexity of the whole affair of going through a tax assessment. If we move completely towards faceless assessment, probably India will be one of the pioneers in that direction. I think in general the consensus that we are having in earlier discussion is that it's a move in the right direction. Any takes from your side, Steve, on that?
Yeah, so I think the government is moving towards the right, in the right way, and e-appeals and again e-penalty systems, everything is, it's becoming very transactional, and then so the people would not have to get biasness of the income tax office or the appellate tribunal. So I think we're going in the right way, and again, even if you look at the income tax returns of the foreign countries where I've worked in, you file a tax return, you get a refund, and then later on the government decides whether it needs to be appealed to or not. And if the amount is of lesser threshold, they just don't care. So the administrative cost of fighting a case versus claiming a refund or not giving a refund was always debated. Now with this, I think this is where we are heading.
So I think the government's intent is to move towards that direction only. Once the online filing comes up and the tax returns of the individuals get pre-populated, I think we will move towards a regime where the refunds start coming automatically, hopefully within a specific period of time. Over the last few years, we have definitely seen a marked improvement in terms of refunds being granted. I think a great move in the right direction. Let's look at some of the final points in terms of how it impacts the employers and employees and what care needs to be taken care of. From the employer's perspective, I think first and foremost, Kamaraju, we discussed and you mentioned about that, probably internal systems need to be geared up to capture the changes, and both of you alluded, Steve and Kamaraju, that probably this year employees will need some hand-holding from the payrolls to the administrations, from the finance function to better understand and adhere to the norms, because you may also have to run two parallel systems sometimes based on the clarification that the government is likely to issue under section 192 for withholding taxes to help the corporate world to comply with the law of the land. So some change in payroll systems may be called for the employee to opt for the new scheme. Quarterly returns, again, some guidance needs to be there for the corporates to comply with the new regime. Change in residential status, again, I think this will be significant impact on globally mobile employees, both inward and outward, including the high net worth individuals and the promoter groups. TDS compliance on ESOP, a very welcome move. I think the request is in general from the industry to widen the scope of the provisions to include the entire industry, if not immediately, at least all the startups which are registered with DPIIT should get covered, rather than restricting it to barely. I read in the press about 200 to 300 odd startups which will get covered, because those are the only startups which are falling within the definition of the income tax statute right now. Big change on the retirement funds, where an overall cap of about 750,000 has been put up for the contribution from the employers. I think industry will seek some guidance on how to tax the annual accretion as well. And what I heard in terms of the post-budget discussions between Ministry of Finance and various chambers, and what we are reading in the media, is that some sort of formula is being designed and it will be rolled out to help the corporate world and the employees to understand how the accretion, the annual accretion, will tax. While the corporates and the employees will have an option to restructure in terms of the compensation packages now based on this tool, but I think whatever earlier contributions have gone in, those need to be looked into in terms of annual accretions over there. In terms of ESOPs we covered, I think the scope should be widened. From the employee's perspective, I think there are some points which the employees need to take care of. One is carefully evaluate their liability under the two tax regimes and choose the beneficial one. And the government has been very kind to say on the budget day as well as afterwards that the intent is to simplify the structures as we go along. But at this stage, we are giving an option to the employees. My own take is that over the next few years, probably the more tax concession will go on. And over the next few years, I don't know whether it is 3 years, 5 years or so, we may see the two tax regimes on the personal income tax merging and getting into a simplified regime. Indian citizens, persons of Indian origin, should keep an eye on the stay in India, considering the proposed changes because that could have an impact on them. Mobile employees, inbound and outbound, need to take care of their residency rules. Indian citizens need to take care of the new domicile residency getting triggered in. Remittance on TCS, a big challenge for the people remitting money overseas as individuals and family members for various purposes. And last but not the least, tool packages need some clarity especially when it is in terms of the corporate expenses. I think that's pretty much keeping in with the interest of time. We will end our webinar today over here. Thank you very much, Steve, Kamaraju and Akhil, for sharing your perspective on the changes in the budget on individual taxation. I'm sure we will hear more from the government, which will provide us more guidance as we go along. Thank you very much, all of you, for joining us in today's webinars. If you have any specific question, do send it to us. Thank you.